Let's dive right into this explainer. Today, we're building a comprehensive roadmap of the 2026 Taxation Amendment rules. Look, if you track the global minimum tax rollout, you already know the stakes are incredibly high for multinational enterprises right now. This new Australian exposure draft is a massive piece of the compliance puzzle. It essentially translates highly technical international frameworks into domestic reality. So let's break down these complex rule changes step by step.
We've got a lot of complex ground to cover, so here's our agenda. We'll start with the 2026 tax update, move into blended CFC allocation keys, and then hit substitute loss carryforwards. From there, we'll cover flow-through entities, safe harbors, and administration, and wrap up with transitional matters and the timeline. Let's get to it.
Our starting point is the official Australian government exposure draft. And you know, this isn't just some routine update. It's a highly targeted instrument. It's designed to seamlessly integrate crucial OECD administrative guidance that was released between late 2023 and early 2026, keeping domestic frameworks perfectly in sync with those shifting international standards.
Part 1. The 2026 Tax Update, looking at its context and purpose.
Before we even touch the math, we really need to understand the why. Basically, this amendment empowers the minister to seamlessly incorporate the OECD's agreed administration guidance. By doing this, Australia maintains its qualified status. If domestic rules diverge from the globe rules even a little bit, the whole system breaks down for Australian-based multinationals. So this is purely about keeping that technical machinery running smoothly across borders.
Moving to Part 2, blended CFC allocation keys and redefining the effective tax rate.
This brings us to Section 456, which, well, it basically demystifies exactly how to calculate the globe jurisdictional ETR. What the draft actually does here is create this branching logic path for a tested entity. Your specific path depends entirely on whether your wider multinational group is already required to compute an ETR for that specific jurisdiction this year.
Notice how the calculation rules fork based on your requirements. On the left side, if your M&E group is required to compute an effective tax rate, the math involves computing adjusted covered taxes without CFC regimes, but you add in qualified domestic minimum top-up taxes. But look at the right side. If you aren't required to compute the ETR, maybe because a safe harbor applies, you pivot entirely to a simplified ETR. It's a beautifully logical, albeit incredibly strict, fork in the road.
All right, Part 3, substitute loss carryforward and navigating deferred tax assets.
Now, this tackles a very specific friction point. Just imagine a situation where your local jurisdiction actually forces you to use your foreign income to plug domestic tax losses before you can even apply your foreign tax credits. That creates a deferred tax asset, or a DTA. The draft sets up a comprehensive set of rules to ensure you don't just lose the value of those credits when you're calculating your globe income in subsequent years.
To keep us from hitting cognitive overload, let's just compare the standard rules against subsections 2 and 3. Those actually permit the recharacterization of domestic source income into foreign source income for later fiscal years. The system calculates the DTA by looking at the amount of domestic income you can recharacterize and multiplies it by the applicable tax rate. Honestly, it's a very sophisticated tracking mechanism for long-term tax fairness.
Part 4, flow-through entities explained, where we trace the chain. Okay, so Section 10.5 dictates exactly how to identify the reference entity of a flow-through entity. Instead of just looking at the immediate owner, which, might also be transparent, the rules force you up the chain. First, you look for a direct owner that is not a flow-through. If that fails, you check the next non-flow-through holder in the chain. And if all else fails, the ultimate parent entity defaults as your reference entity. It basically anchors the taxes definitively. On to Part 5, Safe Harbors and Administration, focusing on the transitional CCBR rules.
If your group is looking for compliance relief, getting this right is absolutely essential. An investment entity must meet these strict, layered conditions to even qualify for the transitional CBCR safe harbor. It definitely isn't automatic. The entity cannot have made transparency or taxable distribution method elections. And crucially, the constituent entity owners must reside in the exact same jurisdiction as the investment entity itself.
When you're computing that safe harbor data, profits and revenues are strictly allocated based on ownership interests. The rules dictate that you only include the financials of the investment entity in proportion to what the constituent entity owner actually holds.
That second slice of the pie, the part held by non-group entities, is completely excluded from your computations. It's a very comprehensive ring-fencing of group assets.
We also have to talk about stateless entities. Section 8200 neatly solves a huge geographical puzzle here for applying the top-up tax. I mean, if the entity is stateless, where do you even apply the tax? The draft answers this super simply. If it's a flow-through, treat it as located where it was created. If it's a permanent establishment, it follows its principal place of business. It's a clean, really effective closure to a potential loophole.
Finally, Part 6, Transitional Matters and the Timeline.
Look, knowing the rules is really only half the battle, right? Knowing when they bind you is the other half. The timeline here reveals a very deliberate retrospective application to align Australia perfectly with the international OECD rollout. The rules apply to fiscal years starting on and after January 1, 2024. Furthermore, the draft pushes back certain safe harbor dates, shifting 2026 to 2027 and 2028 to 2029. This ensures a comprehensive and coordinated global implementation without any gaps. So, we've traced the logic of blended CFCs, tackled substitute losses, and mapped the boundaries of safe harbors. The exposure draft leaves literally no room for interpretation. So I'll leave you with this to think about. How will these comprehensive shifts in ETR definitions and safe harbors impact your group's global compliance strategy? The window for preparation is closing fast. Thanks for joining me on this explainer, and I'll catch you next time as we continue to decode